let's say that the pre-market starts opening up over here, if the gap gets less intense, that really wouldn't add into that feeling of somebody, let's make it visceral again, right? You get stabbed in the gut from Jerome Powell. He's leaving the knife in, that's Thursday, and this morning someone came by and is starting to twist it. It's less of a knife twist if you start opening up closer to 583.85 on better than expected inflation data. All right. So those are some thoughts, those are some ideas as we are thinking about the gap down here this morning. Should you just blind It's less of a knife twist if you start opening up closer to 583.85 on better than expected inflation data. All right. So those are some thoughts, those are some ideas as we are thinking about the gap down here this morning. Should you just blindly try to catch the falling knife? No. I'm not advocating for just going out there and being a button smacker this morning, saying, hey, let's long this, let's go, max lever long, ES futures, I'm going my full account value, time to lever up. No, 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 no. Once again, I'll say it one final time. If you blow up your trading account in the final trading day of the final full trading week in 2024, I have no sympathy for you, right? Please be a good risk manager this morning. If we get a reasonable setup down here, then great. We can try the long on the oversold reaction. If we don't, if there's no reasonable setup, if the market's driving to the downside with huge red-bodied bars on the hourly, even the 5-minute, if the 5-minute chart's looking like this, you're not just blindly buying this level, right? Absolutely not. You need to look for a setup there at 576.75. All right, so we've got about 60 seconds to go until we get the release of the economic data. What we really care about is the market's reaction. So let's go to let's get crazy here. Let's go to a 5-minute time frame chart. Usually we keep them on 15s here for the morning show, but let's go with a 5-minute time frame chart. Let's see exactly how this market reacts here in just a moment, right? So here we go. Giving this, we've got about 50 seconds, and what we're looking for is PCE inflation. Let me actually draw this off to the left in case we need to adjust the charts. So PCE is what we are looking for in terms of the information. And we know that month over month on the core, let's say C here for core, we're looking for a 0.3. And the year over year, and we'll just put the year over year core here. We won't do the full headline. What was the year over year core? Year over year core was looking for a 2.9. 2.9. All right, 2.9. All right, these are the numbers that we're looking for, and the market will start reacting here in about 9 seconds. 9 seconds to go, and we will be getting our PCE inflation data. That is the current outlook. Here we go. Buckle up. Market is mostly unchanged on the release. Not really getting too much volatility. Remember, I dropped this to a 5-minute time frame chart. The y-axis here is only 2 points. Yesterday we were dealing with a 20-point y-axis, 10 times what we are looking at right now. So, market's trying to make a move in the upward direction. Which in my opinion would likely suggest that PCE is beating the expectations here. On the month-over-month core, I would imagine a beat. I have not looked. I'm also not looking at chat. Minimize the chat. Anybody know what that's from? Somebody tell me in the chat. You know what that's from, right? Minimize the chat. All right. Month over month, I would have to imagine comes in at a 0.2, maybe more in line with the normal annualized target. And then year over year, I would have to imagine, I don't know, maybe a small beat. I wouldn't say back down under prior, but probably looking at, I don't know. If I had to guess based on this market's reaction, maybe a 2.8. Maybe a 2.8 there on the year over year. So those are my guesses based purely on the price action reaction. Right? So those are my guesses. Let's take a look. Let's go over together, and we will also look through the detailed report. It's actually, the PCE report is not as detailed as some of the others, but let's jump over there now. Let's go here. And what do we have? Obviously, across the board, you can see, wow, look at that. Look at that. Month over month, PCE core, 0.1. Consensus was a 0.2. Forecast was a 0.3. If you look at the year over year core, we got a 2.8. So I was correct on this one, wrong on the month over month, but correct on that, beating the consensus and the forecast at a 2.9, unchanged from last month. Okay. So, I'm not going to sit here and pound the table and say things like, oh my goodness, these are the strongest PCE reads I've ever seen. But it does at least stop the trend. It stops the trend, right? If I just click into this real quick, the flat read here, this prevents another uptick. If we came in at the 2.9 that was being forecast, that would have been like, okay, this is getting out of hand. We bottomed. We're clearly trending higher. And it's not to say that we're not trending higher, right? We are technically trending higher from this perspective. And as we know, Jerome Powell was infamous for saying this all throughout 2022, right? Or actually more so the back end of 2022, front end of 2023. What was he infamous for saying, right? 2 reports don't make a trend. 3 reports don't make a trend. 4 reports don't make a trend, right? Powell was just, continuing to kick that can down the line over and over and over and over again. So the fact that this is technically an uptrend here, it's higher than where we've bottomed out, but flattening out is at least helpful. All right, it's a good thing that we did not come in at the forecast 2.9 here on the PCE inflation rate. All right, so that is what we've got there. It is probably worth taking a brief glance at the month over month just to see what's going on in terms of the trend. Big downtick here is certainly helpful. Certainly helpful over here. All right. As Frank says in the chat, where's Jimbo from earlier? Jimbo, you still out there? If you are, then yeah, the Santa rally's back. I'm going to get ready to flip-flop again. Maybe I'll release an impromptu YouTube video tonight and say, hey, Santa Claus rally, expect it. That one's for you, Jimbo. I don't know if Jim's in the chat anymore, which is kind of ironic because my father's name is Jim, and it feels weird calling out someone named Jim. The other thing we all know is that you don't tug on Superman's cape, right? So anyone who catches that reference, of course, good taste, good taste. So anyways, let's jump back on over to the charts. Let's see how the market's continuing to react. Basically, the premise here is that the inflation data came in better than the expectations. Let's take a look. Jim Fury says, yeah, it feels weird to me too. Yeah. Markets rallying, continuing to try to extend this gain in the upward direction. If you guys, actually, you know what? I'm not even going to say it. A certain somebody was taking a certain action as this was taking place through the overnight session. You can try to figure out who that person was and what that action was. The other thing that I'm probably interested in is the TLT. Yes, look at that. Yesterday, if you're on X, you probably saw our post. If you're in Discord, you saw our post. But in here, we were also selling more puts on the TLT. I'll speak for myself. I was selling more puts in the TLT. Nice move higher here this morning is going to mean that I've got a little bit of cushion here headed into the next little bit. Will R, my man. Almost like you can read my mind. Yeah, I'll always be a long-term buyer of the S&P 500. I will always be. If you guys caught if you pay attention to different fund managers, everybody knows Tom Lee, right? Tom Lee from Fundstrat. He said, back up the dump truck, full port long this thing, headed into the early stages of 2025. Anybody who has not seen the graphic that Fundstrat produced for their forecast, it's 7,000. Let me see if I can reproduce it really quickly on the SPX here. Let's quickly have some fun. This is what we do. We have fun on Friday mornings, all right? Yes, we'll get serious in a moment. Yes, we'll talk about where we're expecting the market to go, but we have fun, all right? Fundstrat says first half of 2025, expect 7,000, right? This is from Tom Lee himself. Second half, expect a pullback to close here, 6,500. That is the beautiful forecast from Tom Lee. And also, if you look closely on the forecast, he says December 25th, mid-year. December 31st of 2025. It must just be a graphic glitch, but anyways, go check it out. You'll see exactly what I'm talking about. I've posted it a few times over on X, and this somehow also is December 31st, 2025. Tom Lee, there it is. Please don't bring out the lawyers. We're not trying to copyright or take credit for your drawing. We're just putting this on the screen. No lawyer, no lawfare, please. All right.
So anyways, let's drop this back on over to the S&P 500. Let's talk about the ES futures. Let's get granular here, baby. It's Friday. We're having some fun up here in the penthouse. Grab yourself a coffee. Grab yourself a donut. Let's get down to business with some of these levels and continue along. Majesty has been just peppering the chat for ASML. If you haven't noticed, Majesty, we've got a specific order to the show. We will take a look at ASML if we have time at the end of the show. All right? So stay tuned until the end if you really want ASML. All right. Here we go. Here we go. PCE comes in better than the expectation. Market rallies off the lows, as we were just talking about with the... that's okay, Majesty. We're welcoming you here. This is the... it's a rite of passage. It's a rite of passage to get into the proper order of the show. So welcome. I like Seth's comment as well. 7,000 people up here in the penthouse is pretty full. What's up with that like button? Something's weird there. The ratio is way off. What do we see? Question number 1. Let's keep the show on the road. Let's keep it oriented in our process, right? Where are we opening relative to the previous day's range? Obviously, we're opening underneath the previous day's low still. So I'm not trying to sit here and coax you into like, hey, everything's fine and dandy. We're opening back inside the prior day's range. We're not. We are opening underneath the previous day's low. So gap rules are technically in force in the downward direction. We'll talk about gap rules in just a moment. Question number 2, we don't need question number 1.5, right? We're opening under range. Obviously, that implies we're opening underneath the value area. So we're all set there. Number 2, where are we opening relative to the overnight range? Here's the overnight low. Here is the overnight high. What I find most compelling about the overnight range is just simply that there really wasn't much of a counter trend move here after the end of day breakdown. This was an incredibly poor low. If you know market profile references, right? That was an incredibly poor low, and it had been repaired into the close. We broke down through that. So coming into this morning's session, looking at the overnight, this is where the Bank of Japan says, hey, inflation's really hot. This is where foreign markets open up and react to that. This is where the Russian markets keep their interest rate elevated, right? Bank of England also on a pause, right? They did not lower their policy rate. There's more markets reacting to the news, and this is the US PCE. So generally speaking, there was not a whole lot of euphoria over here. Overnight, a lot of short action. Shorts here, and shorts here. So the point being, in terms of question number 2, is just that we really know the influence of the overnight trade is on the short side, and there wasn't a lot of an attempt, or there wasn't really any attempt, to get back into the range from the prior day's session. That's bearish, right? So undoubtedly, we're opening, where are we? We're opening in the midpoint of the overnight range, but the overnight session is trading bearishly, okay? So let's say neutral on question number 2, which is actually very important relative to the gap rules here, and that's because of risk reward, right? Risk reward here is absolutely abysmal for new money longs or shorts in terms of trading, just in the midpoint, in between your gap close, prior day's low, and the overnight low. What are you going to do? You're going to smack the button here in the midpoint, hoping that it does this? What if it does this? Where are you going to put your stop? Doesn't make sense for a logical stop to go anywhere other than right here or right here. So being in between these really leaves you between a rock and a hard place for the market on the open. All right, let's back that off and let's finish off question number 3. Let's put the R back in there. There we go. And let's finish off question number 3 for our interrogation this morning in the S&P 500. What do we see relative to the overnight inventory? Net long, net short. To do that, extrapolate the previous day's settlement. Same thing as saying the close, how much time was spent above, how much time was spent below. Obviously, a lot of time and distance spent below relative to the time and distance spent above. So break out the abacus, break out the measuring stick, yardstick, abacus, what else did we miss here? Compass, protractor, ruler, sextant, if you're someone who navigates by the stars. And take a look and tell me what you think the overnight inventory skew is. Anybody in the chat? Anybody in the chat? What do you guys think the skew is of the overnight inventory as we wait for some answers to roll into the chat? Assassin's Greed with the Canadian $14. Happy holidays to you and yours. It's technically a $13.99 Canada there. Appreciate that, Assassin's Greed. Happy holidays to you and yours as well. Hopefully you have some great time away from the market, and hopefully you are enjoying the holiday season in general. We've got Eugene Garrett with the 5 gifted, very generous on this Friday morning. And then if I go up one more time, we've got Tyler M with the $5. That's US. Like and subscribe or be sent to the dungeon. I actually put together a little illustration of the penthouse yesterday. I'm working on a little special something for a couple of special folks. So we'll see where that ends up. But EM Group as well joined as a floor trader earlier on. Shout out to EM Group. Welcome to the crew. Where are my calculations here? Where are my calculations? Who had it first? Scrolling up a little bit. Batgirl is giving us 97.777. We've got Trader Ned with 97.35. Rockin' Profits. I like the specificity of Rockin' Profits suggestion of 98.687. That precision to me is really what we're looking for. So 98.687. All right. Question number 3. 98.687. All right. If you're new to the Penthouse, if you're new to the Trade Brigade methodology, if you have no idea what I'm talking about here with 98.687%, and remember the 7's always continuing, it's referring to the percentage of the overnight trade that is net short, meaning underneath the previous day's settlement, relative to net long, above the previous day's settlement. So the ratio of this box to this box. And it's very, very important that you calculate this number precisely. If you have not used your abacus, if you have not used your protractor, compass, ruler, yardstick, it's very important that you do. It's important that you get that number right. So what does it all mean? What does it all mean here for this morning session? Why do we care about these numbers? What do we think is going to happen off of the open? Well, we're opening with gap rules in force. Obviously, we can see the risk reward is not great for a particular fade. And the overnight inventory, though, is net short. 98.687% net short, to be precise. So what does it mean? It means that we are looking for some sort of reaction after an initial market move. These combinations of answers right here are not enough to get active on the early morning trade for the first move of the day. That's my take, right? That's the methodology that we subscribe to here. So with that, I am going to clear this up and we will go ahead and continue along. I like all the question marks in the chat. Like, what the hell is this guy talking about? Is this guy off his rocker? I mean, geez. We're talking about a market, but now you're bringing up an abacus and measuring sticks and like, what the hell is this guy talking about? Oh, trust me. You'll figure it out. Come back to the show. Continue to expose yourself to the Trade Brigade methodology. It'll all make sense. So here we go. Let's clear this up. Let's get into the pathing now that we understand the 3 questions, right? The 3 questions are critical to understanding what's possible out of the pathing. I'm going to clear this up. Here we go. 3, 2, 1. Poof. It's gone. The pathing this morning will look like this. We're going to open in here, and the gap rules tell us that we have a specific framework to use. All right, so gap rule number 1, let's say GR. Let's put them all on the screen here together today. GR, gap rules. Numero uno, por favor. We have ourselves, if we test and fail the overnight low, then we are looking for a fade. Now, what's the issue with this? Where's the market suggesting that it's going to open? Here, right? So gap rule number 1 is a test and failure. Test and failure. So in this case, we'll use an up arrow because it's a gap down. On the overnight low. This is about to be a masterclass in gap rules trading, okay? So pay attention here. That means that we would need to see a test and a failure to get back above the overnight low. That's number 1 of the gap rules. So, okay, that would require a pretty substantial move to the downside, about 15 points, 18 points to the downside here off of the open. That's pretty tough to participate in, right? So that's not too helpful. Number 2 of the gap rules, if we're typically applying the standard framework, is that what we want to look for next is a recapture of the opening print. So I'm going to say above the opening print. And please don't make me go on the tangent of what the opening print is. The opening print is the opening print is the opening print is the opening print, as long as you're on a daily time frame chart or lower, right? The first traded price of the day. So if both of these things are true, so let's say if these are true, what would we say? I guess we'll just say T for true. Then, I'm going to say then with an arrow. I get it. It's not a proper arrow function. It's, we're not JavaScript here. It's not PineScript. We won't use a ternary operator. I get it. If that's true, then you want to look for a long to close the gap with a target. So I'll say long, and then the target is the GC, gap close. All right, so that would be that. So what does this look like? That looks like this here. Okay, and we'll use blue for the opening print as we typically do. So the issue with this potential trade is that there's too much distance. There's too much distance between the forecasted opening print, the overnight low, and the prior day's low, which is going to represent the gap close. There's no world in which you would put a stop. Let's actually use the red crayon. Let's keep accounting happy. Final trading day of the last and final full trading week of 2024. There's no world in which you could acceptably place risk in this red box here with reward to look like this green box here. I mean, what planet are you trading on where you're taking inverted risk reward? Terrible, awful. I promise you, you will not last long in the industry if the majority of your trades look like that. If your trades look like this, your win rate needs to be, I don't know, 75% or better. And that's hard. It's hard to be right more than, I'd say like a pretty solid win rate, probably something like 60 to 65%. If you're right slightly more than half of the times on your trades, that's a good win rate. You've got decent accuracy. But if you're trading risk reward that looks like this, that win rate is probably not going to give you positive expectancy. So you can't afford to put a stop underneath the overnight low. So these two things, the first, core framework components of the gap rules, don't really align themselves with a reasonable trade opportunity here. Now, the one thing that maybe skews the risk reward back in the upward direction and might be somewhat favorable, I wouldn't say like, oh my goodness, this is like, this is the best trade I've ever seen. But if you could cut this risk into something like this, right? Some sort of stop loss that just goes right underneath the opening print. If you could use some sort of brigade bolt intraday on the recovery back over the opening print right here as your entry, maybe you could pull off like a 2.5 to 1 risk reward, and that becomes slightly more acceptable. All right, so really what I think is more likely than not to happen here off of the open with respect to these gap rule frameworks, we're probably, and again, this is this is my interpretation based on the good data that we just got from the PCE, based on this feeling like max fear, max pain, right? I don't think that the market's necessarily going to give a full test of the overnight low. You could get a little bit of a drive to the downside off the open, but if we don't test it all the way, you might be able to pull this off if the low of day ends up being like here. And that's just totally arbitrary. I'm not calling for a specific distance to retrace back towards the overnight low. All I'm saying is that if the overnight low is not tested in full, and we're just sort of in here for an arbitrary higher low, you could maybe look for some kind of long over the opening print if there's good enough risk reward to target the gap close. All right, so let's not lose sight of that. The target is the gap close on this particular move, right? This is why we've used, we want this up here, a little underline. That's your target in green, okay? So those are the first two things on the gap rules, and those are the risk reward ranges that I would primarily be looking to entertain, right? The next thing we have to acknowledge here is that number 3 tells us we have to look for a gap fill reversal, right? So when we close the gap, right, that means coming into the previous day's low here, when we close the gap, we will change our tone. So instead of thinking about a fade, we are thinking about a reversal off of the prior day's low, right? So let's say GFR, not godforsaken range, although it started to feel like that back when the S&P was balancing at the all-time high. This stands for gap fill reversal at YLOD, all right, YLOD, prior low of day. PLOD, YLOD, all the same thing. So what does that mean? Well, first of all, it just means that we're looking for resistance here, and the target is back to the opening print. Target, so if that's true, let's use an arrow here. Target, let's say T is going to be the OP, opening print. All right, so your risk reward here suddenly skews back in the opposite direction, where if you can spot sellers up against the previous day's low here, now what you might look for, and I'm just going to draw this tiny in this little sliver of what remains in terms of open charting drawings. Let's do this, and let's grab the green crayon. You would need to find risk reward that inverts, right? Where your risk is, let's shade these in just to make this stand off on the chart a little bit more firmly. And this is looking like a Picasso this morning. If you're new to the Penthouse, we typically try to build out at least one Picasso, if not a Rembrandt. Sometimes we get crazy and we bring out the Jackson Pollock. Never in my life have I considered myself much of a fan of Piet Mondrian, although I can respect what he did for the abstract movement. Never quite got behind that type of stuff. So pretty well versed up here in the in the high arts culture. So, anyways, this is our Picasso. Gee, what's going on? Gee, did you just wake up? What happened overnight? Oh man, we're having fun with G. G is a staple up here in the penthouse. Jesus, Kandinsky, Blueberry. Now we're speaking the same language. Anyhow, the point of this Picasso that we're trying to put on the screen here is you're looking for a gap fill reversal. That's always the typical expectation on point number 3 after you test the prior day's low. And the logic behind this, right? Let's not forget what's going on with the trend. Let's not forget ultimately what is happening with the bears, right? Bears are in control with momentum to the downside. The hourly trend is down. This is the ideal spot for a lower high, right? Keep prices completely outside of the prior day's range. Keep prices underneath the low of the Jerome Powell move from Wednesday. That's just a beautiful lower high. So gap fill reversal, don't lose sight of that. Do not lose sight of that as a potential short idea. From there, obviously, you can balloon runners, or you can try to balloon runners in the downward direction here and start looking for, if we breach the opening print, right, the continuation. Let me use the white crayon here. The continuation of this is something along these lines to the overnight low. That would be what you're attempting to balloon runners for, right? If you could hold one contract as a short runner, looking for that, right? That starts to become like, wow, what's the risk reward on that, right? Really, really impressive. So those are the initial ideas and takeaways from the gap rules here off of today's open. Once again, if I had to start thinking about prescribing odds and probabilities to what's happening here, I really don't think, based on the positivity from the PCE reaction, I do not think we come in for a full retest of the overnight low. I could be wrong about that, but that's kind of what the market seems to be suggesting as of right now, right? Seems like this might be an exhaustion move to the downside. Some other things that we should be mindful of here. Let's get into some of the more esoteric gap rules, right? Point number 4 is all about value area, all right? So if value area, we don't want A first, we want V first, and the kerning between a V and an A, anybody who's a designer knows this, right? The V and the A kerning has to be precise. Value area. The value area is where 70%, just to clear some things up in case you're not familiar, the value area is where 70% of the day's trading volume takes place. Yesterday's value area was right here. This is where 70% of the day's volume took place, had a little bit above, had a little bit below. The value, the bulk of where the transactions were happening, right here in this box, right? Why 70%? Because it represents roughly one standard deviation, all right? So value area, if today value area cannot get overlapping to the previous day's range, if value area cannot get OL overlapping, right? And we just say prior day's range, PDR, all right? OL on PDR, prior day's range, you would expect the odds of a late day sell-off to increase, right? Odds of a late day sell-off. So I'm going to use the arrow here with, I don't know, let's put a little terminus on the left side so it maybe distinguishes from that one. Odds of a late day sell-off. Olds. We're getting old in the chat. Olds, all right? Odds of a late day sell-off increase, right? So what does this mean? You just said a whole bunch of like jargon, Matt. What the hell does that even mean? It means if value area, once again, 70% of today's developing transactions are underneath the previous day's low, which FYI, 59.31, if 70% of the transactions are underneath 59.31 by the time something like, I don't know, 1 o'clock comes rolling around, as we come into the second half of the day, 1:30, as traders come back from their lunch break to button up any positions before they head out for Christmas, right? That's the time frame where I would expect the odds of a late day sell-off to increase. 1:30 and onward if value developing on the day is underneath the previous day's low. Okay? That's point number 4. What else could we say about point number 5? Point number 5 needs to go over here because we do not want to disturb the Picasso. That's being respectful currently of the price action. Point number 5 would just simply be, if we do not see the gap start to close, meaning if we don't see a rally sooner rather than later off of the open, so if the gap does not close, so no GC, gap close, not your general contractor, but your gap close, respect your general contractors. If they've done good work for you this year and you want them to come back in 2025 at the same rate, give them a little gift this holiday season. Anyways, general contractors. If we cannot get a gap closed that starts to unfold sooner rather than later. Now, when someone says sooner rather than later, just like we say late day, that's the gray area of trading. It's like, what do you mean sooner rather than later? Give me a hard timestamp. Unfortunately, I can't. Right? There is a gray area in trading. It's the same thing that comes with screen time. It's the feel of the market. It's understanding the tempo of the market, the pace, the speed of the tape. It's all the same thing, right? If the gap is not closing sooner rather than later, expect to move in the direction of the gap, which in this case, of course, is in the downward direction. If you really want me to try to nail a time frame to that, I would say if it's not within the first 30 minutes, if it's not within the first hour of the day, if you're not seeing any sort of not 30 hours, 30 minutes. Jeez, let's drop an M here so nobody gets confused. If it's not happening, if you're not closing that gap within the first 30 minutes, first hour, I would think that the buyers aren't really stepping into this market, right? So these are all considerations here on this morning's open. The final thing I'll leave you with before we take a look at the secret weapons, aka the 30 months, aka the market internals, which we'll dive into in just a moment here. The final thing I'll leave you with is that we have an OPEX, right? We have an OPEX today. We've seen a huge move from the market over the last couple of trading days. We are easily on a 3 sigma move outside of the expected move from the options market as priced in last Friday. So what I'm getting at is, risk management, please. I know we've had some fun up here in the penthouse this morning. I know we've been talking about high culture, arts. I know we've talked about all the different measuring tools when we were judging the overnight inventory. I know we were talking about PCE, Japan, all this good stuff. I know we're having a good time, but let's be serious for just a moment, right? The biggest thing for today's session, the biggest thing over the next week and a half, really, is to simply not make any stupid mistakes. That is the biggest thing that I would challenge you to do into the end of the year. No stupid mistakes, right? If you can just avoid making a stupid mistake between now and like January 6th, when things might just clear up a little bit, right? January 6th is the first full week of trade for 2025. That's when Wall Street's likely getting back to the desk and markets will return to some sort of normalcy. If you can just not, is it after 9 o'clock yet? It's not. I don't know how, our good friend Vince runs the show over there, but we try not to swear on stream. I really want to use the F word, but we're not going to do it, right? We're not going to do it. You can imagine what I'm trying to say, though, right? Just don't F it up into the end of the year. Make small, good decisions, right? That's it. That's exactly it, right? So, that is that. That is that. Don't F it up into the end of the year. Okay, so the gap rules are on the screen. We know what we're looking for here. We know that the classic continuation of the pathing from the gap rules really stems from this outcome right here. See this outcome that looks really scary? It's a full test of the overnight low. It's a gap fill reversal off the prior day's high. It's a move back down to the overnight low. That is the prime. That's if you wanted to put this in a textbook and study it for the ages going forward, that's what the textbook move should look like. Test the overnight low, fail, which means that sellers are trapped on the overnight low. I know we didn't really talk about the psychology of why the gap rules work, but the psychology behind it loosely, we'll do quickly through this. You want to trap overnight players who are short dead on the lows. You then want to see a move through the opening print so screens go from green to red. Sorry, red to green. My apologies. I got that backwards on the first go around. You then want to look for a move into the previous day's low to close the gap, offering a thin structure retracement. And that's firstly where people should start selling the market, right? Sellers who want better prices now have higher prices to sell into. Anybody who bought the close yesterday expecting some sort of relief rally, they can sell there for break even. That's where you run into trouble. From there, you target the opening print. And then beyond that, if you move through the opening print, obviously the overnight low is back in play as a target. So this would be the textbook, let's say TB, Trade Brigade textbook, TBTB. That's the textbook outcome. Remember that based on the reaction to PCE and what I've been saying over the last, 5-10 minutes, is that I don't really expect a full test of the overnight low. I could be wrong about that, right? Options ICE, yes, gap rules apply to anything. Gap rules apply to anything where there's overnight trade. I should maybe distinguish that. Like you would not apply a gap rules framework to Forex, which trades around the clock, right? Basically, what you're trying to do is you're trying to exploit the emotional vulnerability between participants who transacted yesterday and participants who are waking up to a different market this morning. The point is to exploit shock and awe. Shock and awe, right? Obviously, this is a shocking open. People will wake up today and say, wow, I've got to do something with my positions. Versus if you're just opening in range, you might think, these prices auctioned yesterday. I don't really have to do anything, right? So that is the gap rules in a nutshell. We do have to add in the secret weapon here, which we talk about pretty frequently, but the secret weapon is going to help us out a bunch in terms of figuring out what we should and should not expect, in terms of odds of the gap actually closing all the way. Joe in the chat with the 20. Appreciate that. Thank you for the daily pre-market tidbits. You bet. You bet. The pre-market tidbits, the technical, what do we say? Technical tidbit of the day. There it was. All right, I'm going to clear this up. If you want to see it again, you can just rewind the stream. You can take a look. We're going to look at the internals dashboard, and then we will go in one more time for the full pathing here, and we'll make sure we can get everything done through the core list of companies. I'm not forgetting about ASML if we have time. All right, so clearing it up in 3. This is a Rembrandt. I would not say that this is very abstract. This is pretty. This is not quite a Picasso. Rembrandt more so. Very. It's got some darks and lights, some chiaroscuro for anybody who wants the technical term. All right, so let's clear this up. 3, 2, 1. Poof, gone. Let's take a look at the internals dashboard because this is going to help us. Yesterday, as we were saying, right, we said, hey, if we're opening here, which was over the prior day's close, the internals probably aren't going to be all that blood red, right? But this morning, on the huge gap down, obviously internals have the chance for a big old skew. So what are we going to be watching for? If the internals open up on the breadth, we're talking about breadth first, starting top left, working our way around. If the breadth opens up, let's just use the same example as yesterday. If the breadth opens up at -9 to 1, that means that 9 times as much volume is flowing into down stocks versus up stocks. That's probably not a situation where you would want to put your neck out on the line and say, hey, I'm going to be a hero and try to close the gap, right? No. If this moves in the first 5 minutes of the day to improve, and let's just say that it moves to like a -2 from -9 to 1, right? That is where you would try to fade the gap. If it gets worse, and let's just start talking about double digits, XX on the negative side, then you're not going to fade the gap. Please, dear Lord, if this moves from -9 to like -12, -13, -15, do not stick your neck out on the line and try to fade the gap. Okay? So those are the 2 things that this would help us understand. Let's move along to the advanced decline line, right? And you're going to use all of these in perfect harmony, right? You're not just going to say, oh, this didn't happen, so I'm not going to do it. You're going to use all of this in harmony, okay? You're not just going to focus on one at a time. We're going through them one at a time, but please use them in harmony. Advanced decline line, what do we see over here, right? We know that it's very likely the advanced decline line opens near trend lower zone, -2000. This typically moves like a slug. It's usually a pretty slow read to react, right? If it starts moving in the upward direction, though, or if the first bar of the day in the first 15 minutes is green, you probably want to favor some sort of fade. If it just remains sideways, you don't want to favor the fade. This is probably the least most important if you're trying to weight the data points. This is the Holy Grail. We'll talk about it last. This is the tick. This is the second closest to the Holy Grail. Very likely that the tick opens big red. Big red. Anybody remember Big Red the gum? I feel like I haven't had that in a very long time. That cinnamon, classic spicy cinnamon taste. Anyways, ticks probably open big red here on the move underneath the previous day's settlements and, obviously a move lower through the pre-market with some catalysts, Bank of Japan inflation running hot. So if this neutralizes to 0 in the first 5 minutes of the day, great. That's going to help build the case for a long. If it stays stuck and sideways, and, again, the point of the tick, and we talked about this the other morning, right? It's not about how high it goes, hang on, Matt. Let me invert my thinking here because this is a gap down, right? It's not about how low it goes. It's about how high it doesn't go, rather. That's what we should say. So if this does not make it to the 0 line, if it just sits here at like -400, -500, this is a situation where you do not want to fade the gap. Please do not try to fade the gap aggressively if the tick is sitting at -750 all morning. If it goes to the 0 line, heck, if this goes positive over the 0 line, great. That's where we're rocking and rolling, right? That's like fade this thing all day long. If we're negative, watch out. So the Holy Grail, last but not least, measures from the opening print. That's the whole secret. I'll give you the secret right up front. The secret of the index score is that it measures from the opening print, which is what matters. As an intraday trader, all you care about is from the opening print, right? You really don't care about what's going on from the previous day's close, right? Because you could be rallying here, but still underneath the previous day's close. This is going to be reading red. This is going to be reading red. This is going to be reading, this reads tick by tick, so this will be okay, which is why this is second up to the Holy Grail. But the Holy Grail measures from the opening print. So if things start rallying out of the gates, and keep in mind, this takes into account 30 different data points, 30, and it weights them accordingly to their impact in the S&P 500, right? I talked this thing up, but man, has it kept you on the right side of the trade, right? I mean, geez, look at, look at yesterday. Majority of these prints were down, right? So even as the market was balancing, you probably shouldn't have been trying to fish for longs in here, right? This was a bearish read. So anyways, if this is red off the open, probably don't want to fade the gap, right? If this is green off the open and all of these other things are also taking place that we've just talked about, that's where you want to fade the gap, all right? So that's really what the tick, of course, tick index score is going to help us out with here this morning. We've got 9:08 on the clock. Of course, this always happens whenever we have news as a catalyst and a big gap to talk about. So that's that. That is that. Of course, we have JSS with the 5 gifted. JSS is going back on a rampage, apparently. You guys know once JSS starts, it doesn't stop. 5 gifted. Paul Chong, Daniel O, K, Marcus, and Fib Newton. Fib Newton, that's a great name. On the first go-around. Second go-around, we have L Stam, Turbo, Michael, Audrey, Jerry. And then we just had recently, who just joined, oh, geez, a third round from JSS. A third round. Look at that. I told you, once he starts, it doesn't stop. Programmer, BS. We've got Gramim, Jonathan, and Philip. And then Xenabu joining on your own volition to the Floor Traders. Welcome to the crew. It's a pleasure to have you up here at the Penthouse. All right. Let's continue along, shall we? Let's continue along. We've talked about the ES. We know what's going on here in the Spider's Cash. It's the same concepts, just with different numbers. Please be mindful of your election gap. That's really what we've been talking about over the last little bit. Sorry, I didn't go in with the explicit pathing here on the ES. We talked a whole lot about the gap rules, but what else can we see in terms of pathing? So gap rules will be the primary. Once again, this is kind of the primary idea. And then here, and then if it continues, you're looking at this, right? This is textbook gap rules. This is if the market's going to play nicely. Something that could easily happen, once again, is a higher low that does not test the overnight low. So if I just use another white crayon to do this, right, that could also happen, and then follow these rules. If the market rallies to get into the previous day's range, I don't know that it's a easy long, but it definitely is not a short, right? If we are over the previous day's low, 59.31, it's not a short, but it might not be the easiest long. All I would think is just that the sellers don't have it going on, right? This is an exhaustion gap down if we start accepting in the prior day's range. And I would say the long probably steps in if we can jump back into the previous day's value area. And I'm realizing now that this is still on a 5-minute time frame chart, which is why the price action is so drawn out relative to our normal 15. But this is where I would start to get back on the bull side, right? This higher low back inside of value from the prior day, all right? Obviously, shorts start trading this lower high here. Shorts start trading if this just drives to the downside and sets a lower high under the opening print, right? That's an idea. You could short underneath the opening print. You could look for the equal low breakdown. And our next big level to the downside is going to be hovering down here at 58.25. All right, 58.25. There it is, 58.25, okay? So please keep that level in mind if the market starts to slip a little bit more firmly today. The other thing as well, just as a reminder, we've talked a lot about gap rules. We've talked a lot about the framework that we're applying to the market. But once again, please do not forget that we have an OPEX. Do not forget that we have OPEX today. Options are expiring, means that market makers might try to pin the market here into the close, right? Why? Because if there's a huge amount of value that's set to expire worthless and they're going to collect and just, laugh all the way to the bank over the holidays, then they're going to pin the market, right? It's going to happen, okay? So just please be mindful of OPEX, throwing a wrench in your plans, and not really producing a clean trend day. We have levels that we should care about. Opening print is automatically one. Overnight low is automatically one, 58.66. The next big level to the downside structurally 58.25, and to the upside value area low value area low. For over prior day's low, value area low becomes interesting to set up some sort of long. All right? That is that. The Sankofa, keeping me honest with the clock, yes, it is in fact about 9:12, and we are behind schedule. Yes. All right, so OPEX, keep it in mind. We've talked a lot about the ES today. I think here's why we do it, right? Why do we do it? We do it because if you can at least get the broad market correct, if you can get the direction of the broad market correct, you're probably not going to get yourself into too much trouble in other names, right? If you can understand what the broad market's doing, if you can have that wind at your back helping you in your trade thesis, that's where you probably have the best odds of success, right? So anyways, that's the ES. Obviously, Spiders Cash, similar in terms of psychology, different numbers. I'm just going to walk you through the numbers, right? Apply the same frameworks, right? Gap fill reversal happening up here, right? Same frameworks, different numbers. Sorry, the gap close is actually much higher than that. The prior day's low is up here. I'm just going to drop this in a dotted gray line so we can keep tabs on it. Let's do this. Let's do this. You guys know rule number 2 up here in the penthouse. It's round numbers only. We'll round off to a nickel there. 585.85 is the gap close. So once again, this maybe closes the gap. Gap fill reversal, looks for the opening print, then back down to the overnight low. If you just get an opening drive to the downside, right, overnight low, gap close to the downside from the election is in play. That's 576.75. 576.75. So your key levels, we know the two outcomes that we're really looking for. 569.85, 576.75, 583.85. Less important, 583.85. And for that reason, I think I might just use an underline here. And then we want 585.85 as the gap close being the next most influential level. All right. Any acceptance over 585.85, that's where I think that the counter trend really starts to heat up. Obviously, you're looking for a target previous day's high, right? 590.25 starts to step in as that target here. So all set on the Spiders Cash, 9:13 on the clock. Let's do a speed round through the nasty NASDAQ. Let's see what's going on over here. Let's jump this up to a 4-hour time frame chart. And my God, JSS, man. Sheesh. More gifted subs. Who are the lucky winners this time around? I can't even keep track of where the last round stopped and where the new round started. Maybe 3 rounds of more gifted subs. You have John Eldridge, which is a great last name. If there's any relationship to Chris Eldridge, that would be cool. Chris Eldridge is a fantastic guitar player who plays, of course, with Julian Lage quite a bit. Just absolutely crushes it. Fantastic guitar player. I would highly encourage you to check him out. Mubarak is gifted a sub. We've got Sebastian. I can't keep up with all these. Kirk, Ollie. I mean, the list is just going to go on and on. There's just a ton of generosity in the chat this morning from JSS. We had Shane as well, or Shaheen, excuse me, with the 5 in the chat. And Dow Jones Dave. Nice to see you, Dow Jones Dave. I feel like I haven't seen you in a very long time. Maybe you've just been lurking in the background, but with the... Jeez, it doesn't stop, man. We've got the 2, SCHW. JSS with the 5 gifted again. Afshin joining as a floor trader. Man, it's nonstop. Vincent F with the 5 gifted. You guys are getting out of control in the chat. I'll tell you that. All right, let's try to get the show complete, though. I do want to make sure that you guys get the value you came here for. It is fun to have fun in the chat, and we know we're winding down for the holiday season. Just as a reminder, I know folks are going to start dropping off now that it's 9:15 on the clock. Please, if you took away anything from today's show, please just remember to not F it up into the end of 2024. Small, good decisions into the end of the year. No over-leveraging. Do not try to be a hero. No bad decisions. Don't F it up. Keep your green year, and just remember that the markets will hopefully come back to normalcy starting sometime along the lines of Jan 6. All right, Jan 6 is when Wall Street comes back from Christmas, New Year's break. Then we'll start to move forward from there with a little bit more normalcy, right? Expect some choppy and volatile action over the next 2 weeks. They're shortened holiday weeks. Liquidity is going to dry up. Volatility is going to increase, right? So my final parting words, we're going to keep going. We're going to try to get through as much as we can here of the core list. But those are my final parting words to anybody who decides to wrap it up early, okay? And if I don't talk to you, if you're just going to be tuned out next week, if I don't talk to you over the Christmas break, have yourself a fantastic holiday. Personally, right, I'll be celebrating Christmas. So Merry Christmas to everybody. If you do not celebrate Christmas, if you celebrate Hanukkah, I celebrated some Hanukkah in my younger years as well. Happy Hanukkah to you as well. I don't know. I'm not very familiar with the other holidays, right? But those are the two big ones. Happy holidays. That's your blanket statement. But certainly a Merry Christmas to all who participate. Happy Hanukkah to all who participate, and definitely a Happy New Year as well. All right, a Happy New Year as well. I remember. Geez, don't get me started. Baruch atah Adonai Melech Eloheinu. I forget the rest of what's going on there. But I know some of it. Right? JSS again. Anyways, what's going on with the NQ? We've got ourselves lows. The higher low zone isn't really holding. So, ideally this would have held up over this. It's not doing it currently. So generally, I do have to change my tone a little bit more so on the NQ. I was kind of looking for some response from the buyers up here. Didn't happen. No higher low put in. And instead, you can still count some kind of higher low. I'm not convinced, though. I think that the lower high is too much of a threat now for some sort of like weekly stagnation that persists, daily consolidation that persists. So anyhow, with that, the 4 hour, the threat, of course, remains the same. It's still this 21,750 level. That's the neckline of this. From up here, you could also start using 21.6 as the intraday lower high that was produced over here. Let's drop it down to the, let's go hourly real quick. Let's see what's going on here. We have this, right? So we are gapping down out of the NQ as well. Gap rules will be in play. Take the same framework we just spent a ton of time talking about on the ES and apply it to the NQ, right? We're gapping down. The hourly trend is down. If we go to the 15-minute time frame chart, right, the basic pathing, without diving into the 3.5 questions, we already know what the answers are, right? If we take a look, right, generally speaking, we're looking for a test of the overnight low over the opening print, close the gap, gap fill reversal, comes to the open, through the open, looks for the overnight low. If we get acceptance in the prior day's range, if we get acceptance over 21.3, 21.3 would be a key level for that reason, right? If we're over 21.3, that's where the buyers probably start to build an edge. I would say your brigade bolt here for a value area rotation inside of this box makes the most sense for the long. If the market's just consolidating underneath the opening print here, let's say a lower high underneath 21.1, that's probably where we look for the overnight low and some sort of continuation in the downward direction. All right, so that is that. Continuation to the downside, the next big level is close to 20,775. All right, 20,775. All right, let's not get back to, remember the theme when we had the sevens levels? 17,777. Hopefully we don't go back to like 17,000 NQ, but the sevens, the magic sevens are coming back into play. All right, so there's that on your NQ. Pathing, pretty straightforward, right? Gap rules in play. One more time, opening print, overnight low. Acceptance here is a good start. This is where the bulls are on parade. This lower high here probably looks for a breakdown. Lower high probably looks for this. Okay, remember also OPEX. Watch for a pin today. If you notice that the market really just starts to go sideways and not really produce anything. If you get like a little test to the downside, a little test to the upside, and then we start to neutralize near the open. If you see this, folks, OPEX pin. OPEX pin. All right. I don't want your bank pin, please, dear God. I don't want any of your personal information. I'll never reach out to you over Discord. I'll never reach out to you over YouTube comments. I'll never reach out to you over TikTok because we don't have TikTok. We don't participate in brain rot. I'll never reach out to you over Instagram because we stopped using that a long time ago. I'll never reach out to you over Twitter DMs. Nothing. I don't want your bank pin. I don't want any of your personal information. But I will say that the market is likely to pin at some sort of strike here if we just start to see sideways action that really gets tangled up near the opening print. All right. That's that. My password is password. All right. I can't even joke about that because knowing someone out there probably has the password, they're going to say, why did you say that out loud? Rusty Russell, I know we'll talk about the QQQ in a second. Rusty Russell, small cap, checking on the futures underneath the big breakout level, failed breakout. This has to be a headwind for the S&P. Don't forget it, right? Don't forget it. Headwind for the S&P. Lower highs underneath 2,300 continues to be painful here. Let's take a look quickly at the QQQ. We've got 9:21 on the clock. Maybe ASML if we've got time for it. Here's the move underneath that neckline we were talking about. Left head, right shoulder. Continuing to be somewhat painful if we cannot get back over